Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is John Ensley. John holds the coveted Chartered Financial Consultant designation and is leading a financial planning revolution to help you take back control of your money, of your lifestyle, and your retirement. John believes ordinary financial planning is failing too many Americans after losing almost everything during the Great Recession. John became obsessed with finding safe, predictable ways to save and create wealth, protected from the chaos and the corruption of the conventional financial system. Founded in 2012, John is president of J. Ensley Financial, a fiduciary financial planning company. John also passed the rigorous Series 65 Investment Advisors Law Exam and is one of an elite group of highly trained bank-on-yourself professionals. John works with individuals, families, and business owners who want to take back control of their finances and see their savings grow safely and predictably. So, John, welcome to the show.
Thanks for having me, Keith. I'm super excited to be here.
Yeah, absolutely. I can't wait to dig into a lot of what you do with people. But what I want to start with is really your background. You know, where you grew up and what led you to this profession.
Yeah, I'd love to share a little bit of my backstory. So I grew up in rural Southern Oregon, kind of a country boy stomping around the rivers and mountains in Southern Oregon. And after I graduated high school, went into the Army, was in the Army for about 5 years, airborne infantry, had a ball stationed in Germany. That was a great experience for me. And when I got out of the service, I went to work for a company in Southern Oregon and was kind of in the right place at the right time and had some stock options and employee stock ownership plan and so forth. And I don't know, this was the late 90s, right? Building towards 2000. And if anybody remembers that era, it was, we were going to do an IPO. We were all going to be wildly wealthy and it was going to be amazing. And of course, by the time the tech bubble burst, the IPO didn't happen and it kind of fizzled out at that point. Was still a great experience and a great company. And I left there with a little bit of money in that employee stock ownership plan. So then I decided, well, okay, I did some calculating and realized I was going to be exposed to some pretty serious taxation later in my life if I didn't do something different with the funds that were in that plan. So real estate became my choice at that point. And my plan then, and I'll just preface this by saying I had no idea what I was doing. My plan then was I bought some property in Southwest Washington and subdivided it and was going to build spec homes on lots. Now, of course, this is in the mid 2000s and the build up to 2008. And I was about halfway through my first spec house on the first lot when 2008 hit. And, I made some big mistakes. I borrowed too much money to try and save the project, but I could see what was happening. and it all imploded. So that did not end well. It was a pretty dark time for me. A divorce happened about that time, and kids with some typical teenage stuff going on, and just it was a really trying time. But I'm super grateful for the experience, because that was also a wake up call. And so I started reading, studying everything I could learn to figure out kind of how things work. And it was in the course of all that study, I was on a webinar one night, and an advisor was walking through this example he was using of a couple in their home and their home equity. And then he started talking about a life insurance policy and cash values that we're building. And that was the first time I had been exposed to the idea that life insurance could be something other than a death benefit, that there could be some wealth building value to it. So that really got my attention, and continued studying, and found a couple of books on that topic back at that time, and wound up buying my own policies and getting them going. And I got very, very passionate about this idea. And what the really turning point for me was, I realized that this concept, this idea of using cash value life insurance as a funding source and a financing source and a wealth building tool, could have been my bailout from that real estate project if I had known about it.
Right.
I had been to financial advisors. Nobody had ever shared anything like this with me. And, that would have given me the ability to my original capital that came out of that ESOP plan would have been protected in the policy. And even if the whole project blew up like it did and turned out badly, I would have been able over a period of time to pay that policy back. And that original capital would have been protected, and the growth on that capital would have been protected. Yes, it would have cost me some money in loan interest and so forth, but a total loss could have been averted. So that really got my attention, right? That had I known about this before that project, I could have been my own bailout. And so after having experience with the policies for a couple of years, I just got very passionate. I think every financial plan for every American family should have this as a component, maybe not the whole thing, but as a component. And so I was ready for a career change at the time anyway, and got licensed and completed a number of different training programs, and launched my practice in 2012 to specifically to help people understand how life insurance products can and should play a big role in what they're doing.
Okay. Well, I share going through a divorce during that time as well. I was a full-time broker, and kind of like it sounds like with you, things imploded. For me, it was more like they just turned off my income. And, it just was at a time where people were still buying stuff maybe for retirement, but they weren't necessarily, back whenever things were really hot, right before all that imploded, you could buy a tract home in a production home neighborhood, or you could buy a home out on acreage, and you could still put 80-20 loan where you're putting nothing down other than closing costs. And, those days kind of went away pretty quick.
Yeah, for sure. I had as if appraisals on all the lots with the as if values if I built XYZ home on them, and we were just going to hit it out of the park. It was going to be amazing. And it just didn't turn out that way.
Yeah, exactly. Well, tell me a little bit more about what intrigued you so much on the, on the life insurance piece, and then maybe for the audience, give them a little better idea as to, exactly how that can be used as part of, your financial plan.
Yeah, absolutely. So most people are familiar with term life insurance, where you buy life insurance, you get a death benefit for 10, 20, 30 years, whatever the case may be. And when that term ends, the life insurance is gone unless you renew it or buy a new policy. So most people are familiar with that. A lot of people have that type of product. So the type of insurance that I'm referring to is high cash value, low commission, dividend paying whole life insurance. Those are the policies that I focus on. And with this type of policy, the premium that we put in the policy accumulates cash value over time. And we can access that cash value, usually in the form of policy loans, as a source of financing to really do anything that we want to do, including real estate investing or any other type of investment activity. So we use these policies to as really as a vessel to hold cash and to manage cash flow. The one of the common mistakes is to compare a whole life policy to some other type of investment. So we compare it to real estate, or we compare it to stock and bond investing, or whatever the case may be. But it is really not an either or; it's an and scenario. What we really are using is the policy as a platform to facilitate other investments. And the reason for that is twofold. One is these loans that we can access, this source of financing. And this is where this whole idea of banking comes from, bank on yourself, infinite banking. People have probably heard some of these terms. Is this ability to self-finance the activities in your life, whether that's a big ticket purchase or a real estate investment, or whatever it may be. And you can do that at very, very low interest rates, particularly right now. They're very, very low interest rates compared to what the market's doing currently. And then the flip side of that coin is when we borrow against these policies, the values in the policy in the background continue to accumulate as if we didn't borrow them. So we have two sides of one coin. One, we can access money for financing at very, very low rates. And two is we don't give up anything in the policy by doing it. It's going to grow the same either way. And so those two components together make it a very enticing way to fund, particularly to fund investments. So that's kind of what they are, and in a nutshell, how they're using it. The way I describe this really in a nutshell is it's a system. We use the features of the whole life contract as a system for saving, borrowing, and investing. That's what it is. It's a platform. We save, we build up in it, we can borrow from it, and we can use those funds for investments.
Okay. And what about, is there any kind of protection with doing it within the policy that that the users have an ability to have? Protection against loss, protection against lawsuits, anything like that?
So in almost every state, life insurance values are protected from creditors to some degree. It does vary state by state a little bit. So there's protection that way. And then, of course, it's life insurance. So there's that death benefit there. So, if I've borrowed money and I've made this investment and I get hit by a bus tomorrow, there's this lump sum that's going to come in and help my family settle up those investments and really complete them. I kind of refer to it as self-completing. That death benefit's kind of there in the background to complete whatever I've gotten started, should I not be able to finish it myself. So
yeah, that's a good way.
I think it's it kind of gives you the permission slip to make those investments, knowing you have that security there in the background. So there's those protections. And, the other thing that I think doesn't get hit on with these as often as it should is these are private contracts between an individual and a life insurance company. So there's a great deal of privacy involved. There's really no reporting that happens. There's nothing I report on my tax return every year that has to do with my policies. So it's really a very private system to save, borrow, and invest with as well. And I think that's kind of more and more important as time goes on.
For sure. Yeah, it's nice to not have to also, you mentioned just whether it be disclosing, but also what you're going to be using the money for that you have built up in the policy. Just having the discretion and the autonomy to be able to use it for what you want when you want.
Exactly, and the control and flexibility too. We should talk about that, right? These are really non-qualifying, non-recourse loans. So there's no application. You don't have to share your income with anyone. Nobody's going to inspect your life to see if you qualify for these loans. You're going to fill out a form and check a box, and they're going to direct deposit the loan proceeds into your bank account, a week or less later. It's that simple. And then they're also non-recourse. The only thing that's collateralized is the policy itself. So really what's happening is the insurance company, they're highly regulated in what they can invest in. Insurance companies have to invest in highly regulated corporate bonds, mortgages, government bonds, things like that. And one of the investments that an insurance company can make that's considered very, very secure is policy loans to their own policy owners. Okay, so what we're really doing is we're part of that investment portfolio for the insurance company. They're using our policy. The cash value in the policy is the limit of what we can borrow. And the death benefit in the policy is really the collateral. So if I die and I haven't paid the loan back, they know they're getting paid because they're going to offset it from the death benefit before the remainder gets passed to the beneficiaries. So because of that relationship where the death benefit is really collateralizing the loan, I'm in complete control. I can pay it back however I want to pay it back. I can pay it back monthly. I can pay it back in a lump sum 2 years from now. Technically, I could never pay it back, but there's some problems with that. So I always advise clients, you want to be quote unquote an honest banker and pay your loans back like you would any other source. But I have the control and flexibility. And the property, let's say I buy a real estate transaction using a policy loan, that property is unencumbered. I hold title if I used it for the whole transaction, because that policy is the only collateral. So it gives me tremendous flexibility. I have clients who flip. That's their real estate investment. And so they love it. They can use a policy loan to get into a property or use a policy loan to pay for the rehab of a property. And they don't have to make a single payment on that loan until they sell it. Even if it takes 2 years to sell it, right? They can still, at the time they flip it, then they can come back and pay the loan off. They have that flexibility. It works well for that. So I think that's a tremendous thing too, just to stay in control of the repayment and of the loan and of the terms.
Yeah, I think so too. It's a great tool to be able to use and not have the holding costs that you normally would associated if you're doing flipping with it, that you normally would with say a hard money loan, that they're going to be at least requiring those monthly payments, that kind of thing.
And at much higher rates as well.
And at a much higher rate. Exactly. Exactly. So, well, how does somebody take out one of these policies? What are some of the options? And then maybe tell us a little bit about the mechanics of it, how exactly it works, how much of your investment can you take out?
Sure. So I think the important thing is to find someone who does these policies that knows what they're doing. There's some IRS rules that are built around life insurance and whether life insurance maintains its tax benefits, which the tax benefits are that the cash value in a policy accumulates tax deferred. And when we access it with policy loans under current tax law, we're doing that tax free. And then there's also when we access later down the road at retirement time, we can convert these cash values into a passive income stream to supplement our retirement income. And we can do all of that tax free under current tax law as well when we set it up the right way. So it's important to have the policies built by someone that understands exactly how it works, and so that it doesn't violate some of these IRS rules and lose those tax advantages. So that's number one. Number two is work with somebody you're comfortable with. Unfortunately, in the financial services industry, I think there is a training protocol that goes out in a lot of organizations to be somewhat pushy in the sales process and close deals and so forth. I kind of take a different approach in my practice. I consider myself more of an educator than any kind of a salesperson. And I like to answer every question and educate as much as I can on how it works and how it fits someone's specific situation. And then usually what happens is they'll raise their hand at some point in the process and go, okay, how do we get going? That's my close, right? I don't have much of a close
right.
until somebody asks me, right? So I don't know. That probably just horrified sales trainers in the financial services industry. But so work with someone you're comfortable with, that's listening to you, that understands your goals and objectives. Because I say all the time, this concept can work for almost anyone, but it's certainly not for everyone. And the only way you're really going to find that out is to have a heart-to-heart conversation with an advisor that knows how these products work and how it's going to work for you, and is willing to take the time to help you understand it and then implement it and keep using it correctly over the decades that come.
Well, on that note, John, what would be a scenario where if you're sitting with a couple and they're consulting with you, what would be a scenario where you say, that this isn't going to work for you because of, this reason? What would be an example of that? Because it seems like it'd be a great opportunity for a lot of people And I'm sure it's probably the majority, but I'm just curious on what scenarios it would.
So what it usually comes down to is the replenishment concept, right? So if we're saving money into our savings account, and 5 years down the road we're going to buy something, whether that's a vehicle or an investment or whatever it is, we're going to take that money out of the savings account. The savings account's going to stop producing interest when we do that, and we're going to go buy the thing, whatever it is. And if we are the kind of people who are then going to keep saving and we're going to replenish that savings account for the next thing, then this concept is going to be a great fit. But let's use another example. Let's say we're not really saving money out of our income. We're not building it up. We get an inheritance, and now we're going to go buy the thing. If we don't have any intention of replacing that inheritance somewhere, then this is probably not a good fit. So I have that exact example. Sense. Somebody referred a young gal to me. She inherited $15,000. She needed a car, and they said, "Oh, you gotta do this bank on yourself policy and put the money in there, and then buy the car and then pay it back." And the good intention, I'm sure, in trying to help her in her financial life. But after talking with her for 20 or 30 minutes, what I realized was she didn't have the resources or the intention to ever pay that money back. So I did not recommend that she do that. If you really need a car and you've got the cash, go get the car, right? That's what you need in your life right now.
Right.
Now, here's what you should do. You should start a little tiny policy with whatever you can afford and start building up some savings, start building up some equity in that policy so that 5 years down the road, when you need another car or whatever, now you've got something that you can work with and you're in the habit of replenishing, of saving and replenishing. So that's the example I use a lot. If someone wants to use cash but not replenish it, then this is not going to be a good fit.
Okay. Yeah, that makes sense. And what are most of your clients using the funds for? It's just basically anything. I mean, like kind of like the term is, bank on yourself. Anything that you'd normally go out and get a loan for, you're utilizing this. And I assume that part of the motivation behind that is you're getting the compound interest of it being within the policy, correct? And while you're probably going to be paying, you said there was some type of a fee, the interest that you're going to be paying. Can you give us an idea as to typically how the rate at which these grow, and then also maybe the rate at which the lending side of it comes in?
Yeah, absolutely. So the rate at which it grows, the thing to remember with a whole life policy in particularly is it's going to grow by a larger amount every year for the rest of your life, and there's nothing you can do about it, right? That's what it's going to do. And so that rate will change over time because it gets bigger and bigger and bigger and bigger and bigger over time. So overall, though, over the long haul, it's going to be pretty modest. The actual rate of growth, if you were to plug that into a compound interest calculator over 30 or 40 years, it's probably in the 3 to 4% range. Not terrible, but modest, right? However, what we also have to kind of think about is what if I used that money and I bought a piece of real estate that I made a good profit on? Don't I have to count that now too, right, as part of that scenario? So we don't want to just look at the policy in a vacuum. These policies are made to be used, and the most effective way they can be used is with an investment where you're getting the return in the investment and simultaneously the growth in the policy. And so you combine the two together and it's pretty compelling. But from a purchase standpoint too, the stated rate it varies company to company, but let's say the stated rate is usually around 5%. But that's a simple interest rate. And they apply it, the way they do the accounting is they apply it once a year on the anniversary date of the policy. So depending on how you structure your repayment, if you don't make any payments for 2 years, like the example I used a little while ago with someone flipping a property, then your rate's going to be 5%. It's 5% simple because you made no payments. But if you are making payments, like let's say you bought a vehicle and you're making payments. So a common strategy would be we buy a vehicle and then we make the same payment that we would have made to the bank to the policy. right? And we do that. And so let's say you pay that off over 5 years, your what I call an effective rate is going to be somewhere in the 2% range per year. The way that works out.
Yeah. That's great.
So it's the way I describe it is it's anywhere from 2 to 5%, depending on how you structure the repayment on the loan is the best way to describe it.
Okay.
And so that's the cost. So if you structure it the right way, then yeah, you can pay 2 or 3% on that investment, and that's a great rate, particularly today.
Fantastic. What about so let's say maybe give for the audience an example. If I came to you and I said, John, I just sold a property, I'm going to give you $200,000 to put into a policy for me, or if you can build a policy for me with $200,000. But I'm a real estate investor, and I do want to get the money back out to be able to put it into something else. How much of that $200K can I bring back out, and at what time frame? What are my restrictions as far as
exactly? So again, company to company, it's going to vary a little bit, but just generally speaking, about 90 to 95% of that initial premium would be available right away. So a common story that I tell is a client that I worked with a number of years ago now, was in the military, went overseas for several years, saved up quite a bit of money while he was gone. When he came back, he went out and bought himself a new Tesla and financed it right through the dealership. And so then he found out about this concept, and he ended up reaching me, and we took $100,000 and we put it in a policy. And the day after it issued, right, there is some time involved in the underwriting and getting the policy issued, but the day after it issued, we submitted the form, and he pulled $80,000 out of the policy and paid off the Tesla to the bank, and then paid that off to his policy over the next several years. And today he uses the policy to buy rental properties. So it's, and that's the other thing too, is it's, it's whole life. It covers you for your whole life. So you'll find that it changes over time, right? These policies and what you can do with them kind of leapfrog through your life with those different events. And it's there for you through all of those. I have another client I can tell a story about. It's a business owner. He owned franchise restaurants, and he originally took money out of a qualified retirement plan to fund the policy, used the loan from the policy to open a new location. This was 10 or 11 years ago. Today he has sold that operation. He's not even in that business anymore. And now we're using those same funds to structure his retirement income here, in the next few years. So it transitions and changes based on the needs in your life. It's like this thing that's just always there backing you up, is another way to kind of look at it.
Yeah. That's pretty neat. Let me ask you this. What about, I assume you can put in a lump sum, and also you can start a policy. It may take longer to get your cash value built up, but if you do it as monthly payments. But what about for maybe somebody in the audience who has some health issues, health concerns? I know typical life insurance, whether it be term or whole life, there's sometimes health questions associated with it. That may determine, what kind of coverage you have. Can you maybe speak to that a little bit?
Yeah, for sure. Almost all of these types of policies that are designed for high cash value accumulation are going to be what's called fully underwritten. So that means not only is there going to be some health questions, there's going to be a medical exam. They're going to draw some blood and do the whole thing. And so you do have to be pretty healthy to qualify for these policies. Now, there's also a unique thing with life insurance that basically the owner of the policy, the insured person in the policy, and the beneficiary of the policy can all be different people or entities. So in a case where there might be a health issue, one of the common tactics would be to find out if there's an insurable interest, a spouse maybe, who would be the insured person versus the contract owner. The contract owner controls all the cash values and determines who the beneficiaries are. The insured person is the life that's actually insured in the policy. So there's some strategies around finding alternative. You have to have an insurable interest. It can't just be anyone. And so, spouse, children, business partners, scenarios like that, or how to get around that.
Okay. That's interesting. I've never heard that concept of being able to. I understand the insurable interest piece of the puzzle. So yeah, that's cool. Okay. And then what about with this? I guess what was I going to ask? So you said 90 to 95%, depending on the company. Do you write for multiple companies and kind of pair one up with somebody depending on their situation?
I do. I'm an independent agent, and
Okay.
so I'm contracted with dozens of different companies. There's really a handful that we use for this concept, but yeah, I can use multiple different companies.
Okay. So I assume that's one of the big quivers, arrows in your quiver, as far as helping somebody with their finances. What are maybe some of the others out there that traditional financial advisors maybe just aren't recommending? And I mean, maybe some. I saw that you're a fiduciary, which I think is important. Truly looking out for the interest of your customer. But tell us a little bit about, what all is involved with that. And then I wasn't really familiar with, I'm throwing a lot at you here. Yeah, I wasn't really familiar also with your certification. Can maybe speak to that as well.
Yeah, for sure.
So whichever one of those you want to tackle first.
For sure. I think one of the, as I've done a lot of study and talked with a lot of clients and potential clients over the years, one of the things that I don't think gets enough attention in the conventional financial planning space is this idea of alternative investments. And I hesitate to even call it alternative investments, but things like real estate or oil and gas or some of these things that are considered alternative. I think there's a tremendous amount of success that's been had building up savings, building up cash, and then making alternative investments to grow that cash, as opposed to what I kind of call a cookie cutter approach to financial planning, where I send you a risk tolerance questionnaire and you answer 20 questions and it comes back and says you are a 67. And then I have some financial planning software that says for a 67, these are the funds. Right. And that's kind of the process. Right. It's a cookie cutter process is the way I refer to it. I think the idea, statistically, right, 40-something% of American families supposedly can't afford a $400 bill without borrowing money to pay it. Things like that. So I think there's not enough attention on having liquid cash first, right? We have to be able to cover the emergencies, to cover the needs, some of these kinds of things. So to me, that combination of building up cash that you have access to that you can use in your life, and then using that cash for alternative investments when you get to the point that you can do that, I think is a great 1-2 strategy that doesn't get enough attention in conventional financial planning. And of course, the fiduciary piece, I always think it's kind of funny. So as a chartered financial consultant, and my firm is also in the review process right now to become a registered investment advisor firm. I'm under review at the Washington State Securities Department right now. That should come through any day. So as a fiduciary, right, you have a legal obligation to put your client's best interest first. I've always thought that was almost comical in that, to me, it just seems like a decent human being 101, right? You put your client's interest first.
Right, exactly.
Do I really need like a legal thing to tell me I have to do that? But anyway, that's what that's all about. Being a fiduciary really just creates a legal obligation between myself and my client to make recommendations that are in their best interest, and not mine or anyone else's. And of course that's important, even though that seems like a no-brainer to me. And then the Chartered Financial Consultant designation is through the American College of Financial Services. It's an interesting one in that it's one of the 3 that most of the securities departments consider equivalent. So the CFP, most people are familiar with, the Certified Financial Planner, CFA, Chartered Financial Analyst, and then the ChFC, Chartered Financial Consultant, are all 3 considered the equivalent as a fiduciary for the state commissioner. So the ChFC and the CFP are nearly an identical thing, not quite. It's the exact same coursework that's required. The difference with the CFP is there's one big test at the end, almost like a bar exam, and the ChFC, it's many small tests throughout the process. So that's really what it is. It's an education. It covers everything from insurance to investments to estate planning to special needs planning. It's a whole series of courses. I completed it in about 18 months. Times vary depending on how much time people can put into it.
Yeah. Okay. And what? So how are you getting your clientele? In other words, where are people finding you? What what kind of, do you do any type of what I like to call prospecting because I'm in sales,
Mm-hmm.
but for additional people, how are people finding out about you and the services that you provide?
Well, little did I know when I started this firm in 2012 is that I'm sort of in the financial services business. I'm also really in the marketing business. I didn't really
Right.
understand that at first, and actually my first year was I fell flat on my face for that reason. So I do a number of things. People hear about Bank on Yourself, and they end up finding me through that organization. They read the book, and then they get plugged into the author of that book, Pamela Yellen, and so I get some folks that find me through that. I am also shows like yours, Keith, trying to get out there. This is something I've been doing more recently with the podcast interviews, and I'm thinking about starting a podcast and some of those things. It's all a little uncomfortable for me. I'm not super comfortable being the center of attention. So kind of trying to get out of my comfort zone and push my boundaries and get more exposure this way too.
Yeah, that's
and
great.
then of course
That's
client
great. Yeah,
referrals.
it seems like that. Client referrals, absolutely. Yeah, I mean, a lot of people just simply don't know about this, and so I think that's just, it certainly is something that I can imagine it being at a party and talking with folks about it. I mean, that most people are going to be, boy, tell me a little bit more about that. It seems like something people would want to
For
talk
sure,
about.
and that's why I started this to begin with. Was that I had I known this, it could have made a huge difference in my life, and so obviously it's not being talked about enough. I had a great career in industrial sales and was making great money working for a great company. And I left that voluntarily to jump into this with both feet, just because I want to share this word. I want to get it out there. I want to make sure people understand this is a tool that they can use and then help them set it up if it's the right fit.
Okay. Let me ask you a little bit about, so if somebody's using this and they say they're super young like myself now, I'm getting up there, but somebody that ultimately wants to bank on themselves and invest within this and just continue to build it up, but at some point is going to need to pull money out for retirement, that kind of thing. And it sounds like you have an ability to do that, but can you maybe speak a little bit to, and you kind of touched on it a little bit earlier, but I just want to be clear for my own understanding. When it comes time that you want to be able to borrow against the money that you have in your policy, you're going to be paying the interest rate for it, but there's no income tax, right? That you have to pay to pull some of that out.
That's correct. So under current tax law, policy loan proceeds are tax free. They're not even reportable. It's just money that shows up in your bank account. The retirement income piece of it, there's actually a strategy built around that. So as I mentioned, the cash values accumulate tax free. Death benefits also pass income tax free to your beneficiaries, with the exception of potential estate tax implications if the estate is quite large at this point. And so there's those advantages. Now, the other thing we can do is we can withdraw. It's called a partial surrender, where we just take cash out. It's not a loan that we would pay back. We just take the cash out of the policy. We can take those surrenders up to the basis point. So that's approximately the amount we put into it. And that can all be tax-free, income tax-free as well. So when it comes time for retirement income, a common strategy, not the only one, but the common strategy is we take partial surrenders up to the basis point and then switch to loans. And this is the only time that we don't pay loans back is in a retirement income scenario. So when I'm working with clients on this, what I do is I find a number that starts where they want to retire. Let's say it's age 70, and I want to get them to or beyond age 100. And so I can use the illustration software or other types of software and determine, okay, we can pull $40,000 a year out of this policy from age 70 to age 103. And the policy is not going to run out of money. It's still going to have X amount of death benefit left in it at that point. And so we can massage those numbers based on what the client wants or needs. So there's a million strategies around that. Somebody could say, well, I want to pull 60,000 out for the first 10 years and then drop it to 25, right? So from 70 to 80, I'm going to want more money because I'm going to be doing stuff. But once I'm 80, I'm probably not doing as much. So then I can just drop it down. And so we can work all those scenarios in and figure that exact scenario out for each specific individual client.
Okay. And that's not a decision you have to make at the onset of taking on one of these policies. It's just as time goes on and you say, hey, I'd like to use it for this, then they can consult with you and kind of determine which is the best. Let me ask you another question, if I could, on, what about for somebody who maybe is, in their 65, 70, 75, but they have not invested, they have money saved up. They've got money maybe that they had in their retirement account or whatever, or just, have accumulated over time. Would there be any circumstance where this could be beneficial to them to look at a policy like this?
Yes, there's a couple of different approaches. One of the misconceptions out there is that a 70-year-old is too old, and that's definitely not the case. There are certainly factors at 70 that you don't have at 30. But certainly there are strategies that are available in that scenario. So one of the things we might use, I mentioned the IRS rules earlier, and what they're built around is what's called a modified endowment contract, or a MEC. And so for a senior, for someone older, a MEC, purposely creating a MEC, might be an excellent strategy for them. Because the borrowing features and so forth and the cash values all stay the same. The difference is that it's just not tax deferred anymore. There's going to be some tax effect when you borrow that money. But I can give you a good example. I have a couple whose dream is to buy an RV and go travel around the country for the first 2 to 5 years of their retirement. And so they, just like the situation you mentioned, they had a lump sum sitting in a savings account, and they ended up using a single premium. They dropped that lump sum in, and then they're gonna turn around and buy their RV with it. They're gonna travel the country for 2 to 5 years, sell the RV, pay the loan back, and then what we're actually going to do is surrender the difference. Right. So they're going to pay the loan back with whatever they get for the RV, surrender the policy for whatever that difference is in the loan. And the way it illustrates out, after 5 years, if they do that after the surrender, they're still going to have more than the original amount that they put in. And then that's going to, of course, keep growing on into their retirement, and they can use that for income. So there's a lot of different approaches and a lot of different strategies that are customizable for every individual situation.
Perfect. Okay. That's very interesting. It's certainly something that I've heard, I'm starting to hear a lot more about banking on yourself and the idea of being able to use this. And, I'm definitely intrigued myself to do something. We're flipping some homes and stuff as well. So obviously that would be helpful for that scenario. And let me, I guess, how can people find out more about you, John? And, if they decide they want to consult with you, I know you said you're in Oregon,
Washington State.
Are you licensed, or Washington? Yep. Okay. And, are you licensed, to, cover multiple states, or what?
Yeah, I can work in any state.
Okay.
Work in any state. And my practice has really been virtual from the get-go. Even long before COVID. So before COVID, I would have to explain to clients how Zoom works. I find now I don't have to explain anymore. Everybody knows.
That's right. That's right. Exactly.
But yeah, I can work in any state. And the biggest thing, I stress this so much, that you have to be able to have a heart-to-heart conversation with an advisor that knows how these policies work, and that isn't going to push something on you or sell you on something that you're just not going to be happy with or that you misunderstand. And that's my promise, is that I don't believe in the push or the hard close. I want to educate. I want to share information, and if it's a fit for you, it's going to be obvious. And if you ask me to help you,
right.
I'm happy to help you do that. So that's my promise. And to that end, I've set up a page called jumponwithjohn.com. That's JOHN John. Okay. Jumponwithjohn.com. And what that will do is give you the ability to jump right into my calendar and schedule a free 30-minute strategy session. That's that conversation. It's going to be very low pressure, very casual, and just find out if this might be a fit for you. Then we can go from there. Otherwise, you just hope I can share some information that's valuable. So jumponwithjohn.com is the best way to get me.
Perfect. And we'll put that in the show notes as well. John, this has been really cool. It's really opened my eyes, and I'm sure it has with the audience as well. I've got a couple questions that I ask every guest. And so one, I guess, would be perfect right up your alley. For somebody who's maybe just starting out, what advice could you give them on their investment journey?
Great question. And I have to say, my favorite segment of people to work with are kind of the younger folks that are starting out, trying to get started, because I think they need this concept more so than maybe me or my parents or grandparents did, because some of the tools they had available just aren't going to work very well in the coming decades, and I think they really need this. So I love working with people that are just getting started out, and my advice is get started. I'm kind of a numbers guy. So when I first learned about this, I went back and I said, well, I worked for that company when I was 26. And what if I had known about this when I was 26? What would it be worth today if I had, right? And I went,
Exactly.
Right?
Exactly.
So,
yeah,
don't do that. Don't do that. So, get started. So reach out, talk to somebody. You can really get these policies started. I have clients that are putting $250, $300, $500 a month into their policies just to get them started and get them going and get in the habit of saving and building cash value. So you can get started at a very modest level that fits you. And that's my advice. Find somebody, talk to somebody. I would love to help you if you want to jump on and grab a strategy session with me. But talk to somebody and get started. The sooner the better.
Yeah, I think that's great advice. John, how about a book recommendation? I've always liked to hear what everybody's reading out there and what they find.
So, of course, I have to say The Bank on Yourself Revolution by Pamela Yellen. Right. Okay. That's definitely
Pamela Yellen.
Yep.
Okay.
Definitely one everyone should read. But for me personally, there's been a couple of books that were instrumental. And the one probably that led me to start my practice more than any other was Tim Ferriss' 4-Hour Workweek. And just opened my mind to the whole idea of entrepreneurship and being in charge of my own destiny and control of time and all of that. So, that's a book that I hand to my daughter and all her friends, and
Yeah, exactly. No, that's a great one. Okay, well, all great advice. I really enjoyed having this conversation with you here today, John. And
me too.
Thank you so much,
Steve,
for being on the Wealth Flow.
My pleasure. Thanks for having me.
All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.